Welcome back. Futures are selling off this morning after President Trump's executive order enacting reciprocal tariffs with the baseline levy of at least 10% for all countries beginning this Saturday. The president vowing to make America wealthy again by imposing a 25% tariff on all auto imports and bring production back to America. Watch.
Jobs and factories will come roaring back into our country, and you see it happening already. We will supercharge our domestic industrial base. We will pry open foreign markets and break down foreign trade barriers. And ultimately, more production at home will mean stronger competition and lower prices for consumers. This will be indeed the golden age of America.
Joining me now is 42 Macro founder and CEO Darius Dale. Darius, great to see you. Your reaction to all of this?
Good morning, Maria. Thanks for having me. Appreciate you. My reaction to all this is par for the course. I mean, the administration has been signaling that they've been trying to transition the economy from what we call paradigm A, which is this, this economy that's propped up by excessive government spending that was incredibly K-shaped, to what we call paradigm B, which is an E-shaped economy that's propped up by private sector enterprises. That process, much like weaning yourself off of heroin, is going to take some time and pain, but ultimately we're likely to wind up in a much better place in terms of the sustainability and the durability of our economic exceptionalism here in the United States.
I mean, some of these tariffs are higher than one would expect, or that we expected, really. But I guess some of them represent a bit of a ceiling for what we're talking about. It's opening up room for negotiation, given that the country-specific tariffs don't take effect until April 9th. So we'll see if there's some negotiation underway. Are you saying that you would buy this market that is selling off this morning, the Dow down 1,157 points right now? You want to be a buyer?
Not right now. Absolutely not. No, our clients have been in 0% equity allocation since March, and we expect much more downside over the medium term. But ultimately, that dip will get bought, because you're talking about, I think one thing that was lost in the shuffle yesterday amid all the sort of noise around not noise, but news around the tariffs, is the fact that the Senate is going to choose to use the current policy baseline with respect to extending and significantly expanding the Trump tax cuts. So they're getting a green light from a revenue-raising standpoint to, create additional, tax relief for the country. And so you think about this from a medium-term perspective, we're going to have a significant hit to GDP, a significant positive shock to inflation that is transitory, but it will exist. And ultimately, sales, GDP, and earnings estimates need to come much lower than where they are currently. Yeah. That's going to cause problems in markets. Well, eventually, that dip will get bought, because you're going to wind up with more tax relief. You're going to wind up with Fed QE on the other side, and ultimately you're going to wind up with a much easier comparative base for 2026.
And that's what President Trump said. He's expecting disruption over the near term, Mark Tepper. Looks like that's what we're getting.
Yeah, I mean, look, if this is $500 billion in tariffs, as a percentage of GDP, we're talking 1.7%. So if you were expecting 2% growth, like almost all of that could be potentially wiped out there. That would make this 100%. The largest tax hike as a percentage of GDP in history. Darius, question for you. Do you think a recession is likely? I can share with you anecdotally, I'm talking with business owners every single day, even some who were super pumped up at the end of last year. They're pro-Trump guys. They're in wait-and-see mode right now. They're not moving forward with their growth initiatives, and I don't know that they still have enough clarity to move forward. Do you think that leads to at least one negative quarter of GDP?
Yeah, well, I think we have to separate definitions of recession. So the answer is, I believe, a technical recession is likely. And in fact, I think it's a very highly probable event. And what we mean by technical recession is just a couple of quarters of negative growth. Well, it's like what we saw in 2022, the last time we had a significant fiscal retrenchment. However, I don't believe an actual recession is likely. The NBER style definition of recession, where there's a broad-based decline in consumption, income, production, and investment. Household and corporate sector balance sheets are too strong in order to have this snowball. What is likely to happen is just a level reset in economic activity lower as you factor in the impact from the tariff hikes as well as the DOGE budget cuts. You have a significant fiscal retrenchment, but this is not a sustainable, durable process. And moreover, we have this thing called deregulation that's going to unlock the financial sector to kind of that's working in the background. So ultimately, you wind up having this level set down in growth, level set higher in inflation, level set lower in earnings and earnings expectations, and ultimately a level set lower in markets. And then that's the dip you want to buy, because guess who's going to be buying bonds from you at some point? And that's my man, N.J. Powell.
Yeah, great point.
Yeah. And Darius, like the only real bright spots you can see as a response to this in the markets are gold price popped up above 3,200 per ounce. And then also that 10-year. And Secretary Bessent's made clear that they're gauging rates on that 10-year yield right now sinking down to 4%. But my question is this: if the Senate goes forward trying to use this current policy baseline where they don't need to pay for $4 trillion worth of extending TCJA, does the 10-year stay low, or does it rebound? Does that yield rebound back up?
This is something we were talking to our clients about actually last Saturday. You're probably going to see the 10-year trade lower as the market resets growth expectations significantly lower. However, you're going to want to sell bonds to my man Jay Powell at some point, because ultimately you're talking about adding $5 to $9 trillion of additional debt to the public sector balance sheet over the next 10 years, as if you could choose the current policy baseline with respect to extending the TCJA. Now, there will be dynamic scoring. I'm not here to argue about dynamic scoring. What I'm here to argue about is what the bond market response is likely to be, and ultimately that you're talking about higher yields, wider term premia, and that'll likely coincide with the recovery and growth expectations as well.
How much more important do tomorrow's jobs numbers become, given now these new worries about, as you call it, a technical recession? Your expectations for the jobs numbers?
Thank you, Maria. I don't think tomorrow's job numbers are relevant. I mean, we can see in the high-frequency data like jobless claims and other high-frequency data points that we have not seen a material hit to the labor market. Don't forget, the labor market is a lagging indicator. What we're more likely to see are a continuation of the soft data rollover. They will have more hard data rollover, much like we saw at the February PC report, and then ultimately that will feed into the labor market vis-a-vis declining corporate profits and corporate profit expectations. So this is something that, again, we have to have a level set lower in growth expectations. We got to wean ourselves off of this, fiscally supercharged economy. Government expenditures, 25% of GDP, higher than any pre-recession, or non-recession, non-war metric in history.
Right.
I mean, this is a painful process, but it's a necessary process to prevent a sustainable, durable fiscal crisis over the long term.
Got it. Darius, good to see you this morning. Thanks so much.